about to hear my conversation with our chief fixed income strategist, Dustin Reid. We talk all about the U.S. election results, what that might mean to trade, inflation, the Fed, and Canada. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a podcast from Mackenzie Investments. My name is Matthew Schnurr, and I'm back with my regular guest, Dustin Reid. Dustin, welcome back.
Hey, Matt. Thanks very much for having me back.
Unsurprisingly, we have a lot to talk about on the heels of the U.S. election, in which Trump won fairly decisively. Looks like Congress is going to head to the Republican side as well, so a unified government there. I'm curious at this stage, there's an adage that I've heard where you're to take Trump seriously, but not literally. And I'm curious if you're thinking about the coming administration in those terms, or how you're starting to think about impacts generally that the new Trump term may have.
I think that adage is probably, let's say, not wrong. We know from the first administration that there was a lot of information, right? The news flow was very, very significant.
Sure.
And I expect that it will be very significant for the second Trump administration as well. Should we take everything literally? No, we shouldn't, which I think gets to your point. But I do think we should take it seriously. And in the significant amount of news flow that we will probably be getting, there will be parts that are more important than others and more salient and maybe more likely. And so the filter and understanding what's salient and what's not, as we say in markets, kind of noise versus signal. And how to filter the signal through the noise, I think, will be very important. I mean, the first part is probably going to be on China and on tariffs. And maybe tariffs not only on China but on rest of the world. I think the first three things that Trump is going to focus on when he gets into office after Inauguration Day, around January 20th, will be tariffs, immigration, and deregulation, maybe particularly around energy policy. And on for markets, I think all three are important. Immigration is important in maybe a second derivative way, what it may or may not mean for the economy and jobs and inflation. But tariffs are probably front and center. And we've heard a lot of rhetoric, kind of back to your point, around tariffs. And so I spent a lot of time thinking about and talking to people around the idea of tariffs as a means to an end and tariffs as the end goal, particularly around the 60% number for potentially for China, Chinese imported goods into the U.S. And I don't think we'll end up at 60%.
Okay.
I do think there's a pretty good probability that we'll end up at something that's not insignificant. But I do think that there will be a point in time where there will be a back and forth in terms of using tariffs as a leverage point, as a means to an end to get something else. And maybe that's more purchases of U.S. goods or something to do with the dollar or military something. It could be a whole host of issues. And by the way, this 10% rest of world tariff, potentially, I think you could also use the same line of argument. Could Trump use the threat of additional tariffs towards Europe for, in fact, as an example, to try and ascertain some sort of, military spending or, reciprocity on U.S. manufactured, anything U.S. manufactured. But I was thinking autos in particular. There could be dozens and dozens of ways to look at it. So I think it's going to be, challenging. I mean, having, worked through the first Trump administration, half working in the U.S. and then half with Mackenzie in Toronto, we have the experience in terms of kind of understanding at least partially how these things go and trying to, again, kind of scrub the data and understand the signal through the noise.
That's a great commentary. I want to just maybe stick on tariffs a little bit and trade in general. Another known unknown, I guess, is not just the magnitude of tariffs, but of course, a reaction from other countries in the world.
Yeah.
What do you think the likely impact is on sort of tariffs being applied, I guess, both from the economic point of view, both US and then, say, rest of world, and then inflation as well?
I can see if it's on the, let's take them in basically two main buckets, China and rest of world. You could
Sure.
argue China, rest of world, and maybe North America, USMCA. But
Hmm.
that's probably not a first half 2025 problem. So let's maybe just park that for the moment. Um, on the China side, I mean, the risk is clearly to me supply chain issues, and we
Right.
have a bit of a rehash, not the same amplitude or magnitude that we had in 2021 during COVID,
Sure.
but supply chain issues translate into higher prices. So not only for services, but in particular for goods, and we get out of this kind of
Hmm.
goods deflationary environment that we've been in for a number of quarters now that has helped to suppress, basically offset higher or still relatively high services inflation and get inflation in the US lower, although not extremely close to the target, right? Core PCE is running at 2.7 year over year. So still decent clip above target. So I think that's a concern. I mean, when we did this the first round, Trump 1.0, so to speak, the China tariffs did not come in right away. So
Right.
I would point that out. Not that that's not going to be the case this time, but just to kind of look back. So it didn't come in right away, and they were generally not seen as significantly inflationary. In fact, some people think it really didn't have an impact at all. Now, I would say that we were in a different inflation environment, obviously pre-pandemic when that
Sure.
happened. And inflation, broad trend of inflation, we're having trouble even seeing upside 2%. It was below 2% and having trouble getting it higher to 2%. And so that was, it's a different era. Now we're kind of on the top. We are on the top side of that, at least in the US. And so, what's the impact? I tend to think that I don't think Trump is running again in 28. And there's a debate whether he can or he cannot. Not really the point. The point is, I think this is Trump's second term and last term. Is he going to wait 2 or 3 years for China tariffs? My guess is no. My guess is it's going to come a lot earlier. It could come within the first few months. And we're in a different inflationary environment here. And so I think that depending on what happens and how significant it is and on what goods or other he puts tariffs on, if he actually goes through with it and doesn't just kind of threaten to do it, but actually does it from an executive order perspective, I do think it has the potential to be inflationary.
Okay.
And I think the Fed's concerned about that too. I suspect that the Fed has done some preliminary work around what the impact could be. And I think and we can talk about the Fed if you want, the Fed meeting this week. And I think the Fed is giving some hints around just easing up on the gas a bit in terms of rate cuts and maybe doing a skip or a pause because I think given what's happened in terms of the U.S. election, the Fed believes that it could be inflationary. Now they didn't say that, so I am putting words in the Fed's mouth, but I think it could be inflationary. So I think that's pretty significant. I think I should say more interesting, but maybe just as interesting. I mean, I don't want to use the caveat depend all the time, but let's assume there's a 10% rest of world tariff on all goods going into the US. That is actually the bigger impact on the US economy,
Hmm.
I think, versus the 60% China tariffs. I think that the 10% rest of the world is actually a bigger deal in terms of upside inflation. So the number is not as exciting, 10% versus 60%. And the term, obviously, rest of world is kind of okay. It's just out there. It doesn't really get specific. But I think that maybe in the description, it actually doesn't give as much importance to what that 10% rest of world impact would be on the US economy. So that I think could be even more inflationary than the China 60%. And I don't think it'll be 60%, just for the record. And I don't think it'll be 10% rest of world either. But if you just said, okay, this versus that, I suspect that the 10% rest of the world is a bigger deal for the U.S. And so then you would also see you have that upside inflation, perspective. And then what does it mean for the Fed? What does it mean for aggregate demand, consumption? what does it mean for fixed business investment, supply chain? Obviously, these things don't happen in a vacuum. So Trump institutes a 10% rest of world tariff on imported goods into the U.S. I don't think everybody else is just sitting there doing nothing.
Yeah, of
So
course.
then there's the reciprocal or the reciprocity of whatever happens, and that's very, very difficult to model because you don't really know what that's going to be, and it'll
Sure.
probably be different by state or region.
Yeah.
So there's a lot to think about and a lot to work through. I do think that we are going to see, at least initially, and probably early in the presidency, the threat of tariffs as a leverage point. And then if nothing done, depending on what happens, if the deal is not made, so to speak, then we could see some actual tariffs hit via executive order.
Great commentary. I do want to move to the Fed, but before getting there, I want to talk a little bit about taxes and the deficit. The Trump initial tax cuts are set to expire, and I think the expectation is that he'll, at the very least, continue those tax cuts, if not extend in various parts. I guess what's your view on where the likely tax policy and then also impact on deficit is likely to come in, and how important is it to have sort of all three, the House, Senate, and President Republican for these discussions?
Right. Yeah. Well, there's a lot there. We could do an hour on that question for sure.
I'm
It's
sure.
it's very interesting. So what we know now, we're recording here Friday morning.
Right.
I mean, obviously, Trump looks to be the president, and we just got word yesterday. It looks like that McCormick has won in Pennsylvania for the Republicans for the Senate. So that looks like 53 for the Republicans, 44 for the Democrats, with three races outstanding, of which two Democrats and one independent who would, I think, caucus with the Democrats. Um, is the current state of play. That could change, obviously, but if nothing particularly changed, you're looking at a 53-47 Senate for the Republicans. So not right on the line, but not a huge majority either. And I would also note that there are two or three Republican senators that are not fully aligned with Trump's agenda. I'm sure
Right.
there are more, but really not aligned. Romney, and then the senator from Maine and the senator from Alaska, I think,
Yeah.
potentially as well. So, obviously 53 minus three. Okay. So interesting. We'll see how that goes. And then the House, depending on the feed, looks like around 205 or 10 or so for the Republicans. You need 218 to have majority in the House. And regardless of, I think, whoever wins it, and even the betting markets are still at 97 or 98%. It's going to be a very narrow margin in the House.
Right.
The House is important because that's where most tax policy is. I say born, but it kind of originates. The White House is important. Obviously, the Senate is important too, but the House is really important. And so the party that wins the House will be the chair for, presumably, the chair for all the committees, including the committee that puts tax policy together. So that will, is it going to come out of a Republican lens or is it going to come out of a Democrat lens? So that's why it's, besides the sweep itself, that's why it's very important to see who ends up winning the House. If the Republicans win the House, which very much looks like the case, it could have a surprise, but it very much looks like the case, then I think the TCJA, the Trump tax cuts, which the TCJA is just the Tax Cut and Job Act, which is that's the acronym for it, which is the Trump tax cuts. So TCJA is probably a first half 2025 agenda item. If for some strange reason the Democrats managed to control the House here, which does not look like the case, but we'll need another week or two to probably get it sorted with all the ballots that still need to come in for California and all the close races on the West Coast.
Yep.
TCJA is probably a second half 2025 event, but regardless of the election, and we said this going in, regardless of what would happen in the election, the TCJA is expiring at the end of 2025. So if nothing gets done, it expires, and then to extend it, then something needs to get done, and you could extend it as it is, which is very unlikely, or you could extend it with tweaks. The big deal, I think, for markets, there's a few things. The overall deficit, I think, really matters from a fiscal perspective. We'll talk about that maybe a bit in a sec. From maybe an equities perspective, the big one is the corporate tax rate.
Of course.
And can TCJA be extended at the current corporate tax rate? And the discussion, I think, by Trump a few times, again, kind of back to the first question, signal versus noise, we'll see what we get, is will the corporate tax rate be lowered? The capital gains is also important. Personal tax rates are also important, of course. But I think the market's been very focused on, will the corporate tax rate either be the lower corporate tax rate be extended, or will it even be lowered? So, which is obviously quite good for EBITDA line below, and then if you kind of couple that with Trump 1.0, very very strong nominal GDP, which is generally good for risk assets and equities, and you kind of have that double shot, and here we come, 6,000 S&P, here we come. So I think that's the big one, and what the market's going to be focused on. So I'm interested to see, obviously, who wins the House and what the majority is like, and then how things go from there. But I expect that the discussions around, from a legislative congressional perspective, tax perspective, are going to get going late Q1, early Q2, and they're going to try and continue that policy and probably increase it. On the fiscal side, maybe very quickly, from a fixed income perspective, the market's been somewhere between somewhat and quite concerned about a big tax and spend policy by either a blue sweep or a red sweep.
Sure.
And what does that mean for the debt? What does it mean for inflation? And what does it mean for issuance from the Treasury? And will the Treasury need to issue significantly more debt, significantly more paper? And if so, that supply of paper with the same amount of demand probably means lower prices, and lower prices means higher yields in fixed income. And obviously, more supply and less demand means even more lower prices and higher yields. And so that's been the concern around my kind of day-to-day space within the fixed income space. And so I think that's that's clearly a concern at this point. We will have to see what that tax and spend policy looks like. We've seen the market Tuesday, Wednesday, election day and night, and into maybe early Thursday with that price action in fixed income. So prices lower,
Right.
yields higher. But to kind of finish out the week, yesterday and today, obviously at the Fed meeting yesterday, Thursday, we saw yields climb back, and actually, somewhat surprisingly, since Monday, we're about net even, almost unchanged on in the 30-year space. So that's a little surprising, I would say. So that's what I kind of think's going to be happening on the big package. But there'll be other tax and spend packages that come along, but TCJA is going to be the big one. And kind of along those three priorities I talked about from an executive order perspective a couple minutes ago: immigration, tariffs, and probably some deregulation, particularly in the energy space. From a legislative perspective, I expect the TCJA to be front and center.
Makes a lot of sense. Why don't we turn to Powell? Doesn't seem like a very enviable position, to be honest, with so much uncertainty coming soon.
Yeah.
We did get the 25 basis point cut yesterday out of the Fed. Maybe start with the narrow comments around the decision, anything that Powell said that you thought was intriguing. And then I'd love to get your view on what Powell's able to do, like in the, I guess, lame duck session before there's a lot of transparency on what Trump will do.
Yeah, sure. Yeah, good questions. I think so. Yeah, 25 yesterday, as expected. Market was basically
Yeah.
fully priced. It's not a forecast meeting, so we didn't get a dot update. So we just had the statement and then the press conference. In the statement, some changes, absolutely. Some people took small changes, but some people took the changes to suggest that the Fed may a pause or skip, and was kind of moving a little bit away. But during the press conference, Powell basically said, no, the changes in the statement were basically to reflect the fact that this was a 25 basis point move as opposed to the 50 basis point move that the Fed obviously led the cycle off with back in September. So maybe you believe that, maybe you don't. I think the press conference had, as is almost always the case, a little bit for everybody. It's clear there's kind of a couple things going on. One, so just to be specific, the 25 basis point rate cut took the Fed funds rate and the Fed funds rate is actually a range. So 4.5 to 4.75, having been at 4.75 to 5 before the decision yesterday. So, and I say that just because to give it perspective to where maybe neutral is for the U.S., where are rates neither accommodative nor restrictive. And I think Powell believes, and I think Powell's speaking not only for himself, but probably for the majority of the committee, that interest rates, even with yesterday's 25 basis point rate cut to 4.5, 4.75, is still restrictive.
Hmm.
And so there's still some runway to get to where neutral is. And it is a bit of a debate as to where that is. And so I think Powell still has some runway to cut rates at the December meeting by 25. But he also in the press conference effectively said, I don't have the wording in front of me, but effectively said, we're just having the initial conversations about what the pace and the cadence of rate cuts should be for the cycle. And the reality probably is that they're probably a little bit further along than just the initial discussion. But the fact that he said it and he got questioned on it, so he didn't really bring it up completely on its own. And he's obviously being questioned on it because of the risk around Trump and tariffs and what does it mean, et cetera, and inflation, like you and I have already covered in this podcast. And I think that he's bringing it up just to kind of put the marker out there that the skip or a pause would be longer than a skip, is becoming maybe more than slightly more likely in the near future, potentially as early as the January meeting. There is a meeting in January. So I think clearly Powell does not want to touch the election and Trump and fiscal, and it's not. And he said that, got not surprisingly asked about his tenure under Trump, and what does it mean, and what does the fiscal story mean, and all these things. And he's actually stick handled it very well. To your point, a pretty tough position to be in, publicly from that perspective. I think the Fed has probably done some modeling work. Actually, I wouldn't even. I think more than probably, very likely, done some modeling work. Uh, Obviously, using some example, although it's like I said a few minutes ago, a bit of a different example from Trump 1.0, but some modeling and some expectations analysis, scenario analysis around what various tariffs will or could mean and the impact on the U.S. economy, not just the China one, but obviously the rest of the world, etc. And I think that there will be, I don't know this for sure, but I suspect there'll be some people inside the Fed that will be saying we do not want to be significantly cutting rates and continuing on with a rate easing cycle if there's a high probability of uh, tariffs happening in the first half of 2025.
Right.
That's the wrong policy. So the probability of at least a skip, I would say right now for me, the January meeting is most likely. So I think they do another 25 because they have some runway, which would take them to 4.25, 4.5 in terms of Fed funds, which I
Mm-hmm.
think is still well into restrictive territory. So I don't think that's controversial. And then just as the calendar works, I believe inauguration day for Trump is January 20th, and I believe the Fed meeting is after the inauguration day. The January Fed meeting is after inauguration day, FOMC meeting technically. So I could see the Fed skipping at that meeting, just waiting to see what happens. Who knows? Trump on day one may say, do this, or tariffs.
Right.
And that could have an almost immediate impact in terms of how firms use pricing power, in terms of their expectations around imported goods, supply chain, their outlook for 2025, etc. So that's how I think the Fed's looking at it. We've been looking for the Fed to obviously cut well into the threes, as I say, with a three handle. And I think it will get there. And
Mm-hmm.
Powell did say yesterday, we're still very comfortable getting rates down towards neutral over time. But he's starting to sprinkle in a few caveats that seem to suggest this is not going to be consecutive meetings. This could be either non-consecutive meetings or quarterlies, 25 basis points every quarter. A lot of it obviously depends on the fiscal story, TCJA, and on the tariff side. So
Right.
there's a lot of policy implications here. It's challenging to your point. It's challenging for the Fed, and it will be challenging for markets to try and understand what is signal versus noise, and what's in the price and what's not in the price, and just kind of the probability and scenario analysis will be very, very tricky, but very interesting and very dynamic macro environment for the next couple of years, I think.
Well, I'd love to get your view as well on what all this means for Canada. We sit in
Sure.
Toronto, a little self-interested on this one,
Sure.
but I'm curious. Maybe starting with the BOC
Hmm.
and their ability to sort of diverge from the Fed. If the Fed does start skipping or at least lessening the pace of cuts,
Hmm.
Bank of Canada, very different situation that they're faced with the slowing Canadian economy,
Yeah.
et cetera, and frankly, inflation quite a bit lower than in the U.S. What's your view on Bank of Canada? How much they're able to diverge from Fed, and does the outlook change at all because of the Trump election and like?
That's a great question. So I think one of the strong views as a team we've had for the last number of months is that the Canadian economy is clearly underperforming the U.S. That's not a surprise, but the view has been that Bank Canada can cut significantly more than the Fed. Potentially, there can be 150 or 200 basis point spread between
Oh well.
the Bank of Canada rate and U.S. Fed funds, so the administered rate, so to speak. And that's not unheard of in terms of recent history, but as I say, that's kind of almost generational.
Mm-hmm.
It's pushing the limits. It's interesting. This week we had Senior Deputy Governor Rogers from the bank say that um, we're not close to the differential from where the bank can move rates versus the Fed, which I thought was really interesting. But to be fair, she is just repeating what Governor Macklem has said at least once, if not twice, in the past 2 or 3 weeks. So you're hearing from the two most senior people at the bank that we are not close to where policy spread, so to speak, can be. And just keeping in mind, I guess it was about 100 basis points before yesterday, probably down to about 75, a little more than 75 basis points now in terms of spread. So
Right.
we view that in kind of the 150 or 200 basis point neighborhood. So at least for now, the bank doesn't think that that is going to be a big deal. I mean, clearly, everyone needs to have a little bit of a think around Trump policy and what does it mean. As is often the case, is kind of on one hand this, on the other hand that.
Mm-hmm.
So on one hand, if nominal GDP growth in the U.S. is booming, I mean, it's probably good for Canadian growth on the margin. I mean, it's probably not negative. Let's put it that way.
Mm-hmm.
So, the degree or amplitude is, maybe the secondary question, but it's probably constructive. I think oil, if Trump allows drilling on federal land, I think the commodity price could be lower, oil
Mm-hmm.
could be lower, but it could be very good for producers. And we obviously have a lot of producers here in the country. So again, kind of on one hand, the commodity price is lower, although we're obviously doing Western Select generally a lot of our oil in Canada, not all of it, but a lot of it, which is a different price point, not WTI per se or Brent oil, which is the global benchmark. But producers could be doing quite well. So again, kind of on one hand this, on the other hand that, and obviously on USMCA, which we haven't really talked about yet.
Yeah.
So different to the tax legislation that we spent a little bit of time on earlier in the podcast, which is expiring, and I use that term purposely at the end of 25. USMCA, which is kind of the new NAFTA that Trump put together during Trump 1.0, USMCA is up for renewal, and I use that term very specifically, is up
Right.
for renewal in 2026. And so if no one did anything and just ignored it, it would just continue on in its current pace. So it is not expiring, and it does not technically need to have a rehash. It is very likely to have a rehash, I think, because Trump will probably want to do it. But I don't think it's early table stakes for him. I think it's a second half 25 thing, particularly given what we chatted about before. I think getting the expiring tax bill done or rehashed in the first half of 25 is probably the priority. It doesn't mean they can't do both at once and there'll be staff working on everything, but the priority for the administration is probably the tax stuff over USMCA. So, if and when that happens, again, I think that's a second half 2025 story, and we'll see what the main sticking points are. At the time, obviously agriculture, dairy, lumber
Mm-hmm.
have always been, auto parts, autos themselves. Obviously, Mexico's involved in USMCA as well, such as Canada's story. So those have been generally some of the bigger sticking points, either pre-Trump or during Trump 1.0. But I think people that are very concerned about, oh no, this is terrible for Canada. I don't think that's necessarily the case, particularly for the first half of the year. Again, this is why I'm spending so much time on what I think the priority set could be, and I
Right.
could be wrong on that. And it probably will be slightly different. But if I am correct, then I actually think that kind of the uncorking of the bottle for, as I call it, for small and medium-sized businesses in the U.S. that have been waiting for the outcome of the election decision before, do I hire more people? Do I not? Do I invest in capital resources? Do I not? What do I do about fixed business investment? A whole bunch of stuff. And now that they have some certainty in a way, you could see a resurgence in small and medium-sized business confidence, and that's probably good on the margin for Canada. So I
Right.
don't think that it necessarily gets in the way of the Bank of Canada. I still think the bank will cut by 50. The labor numbers here are still on the weak side, particularly given the population growth.
Uh-huh.
Although wages have been a little bit more frothy than I would have expected, but I still think the bank has runway to cut by 50. And if they do cut by 50 in December, just to state it, that would be from 3.75 to 3.25, and that's important because 3.25, I believe, represents the top end of what the bank thinks is the neutral range. Speaking of neutral, the neutral range for the country, which the bank believes is somewhere between 2.25 and 3.25%. So you're right on the top end of that range, and so then it gets interesting. Now you're starting to fine tooth it. Like, where do you want to be within the neutral range? And do you want to be even below the neutral range? And again, we would expect that we'd probably be at the lower end of the neutral range or even below. We think terminal in Canada is somewhere around 2.5% or maybe even 2%.
Great. One last quick one. The picture that you just laid out with the interest rates lower, oil prices potentially lower as well, sounds to me very much like a weakening Canadian dollar versus USD. One, do you agree with that? And two, does that accelerate trade but make my vacations more expensive?
It might. I think, so we have that trade on. We are short Canadian dollars
Okay.
across many of the portfolios against US, and yes, that makes sense. I mean, I think the rate spread story is clearly negative for the Canadian dollar. I think that's absolutely fair, particularly given where market pricing is. The market is not as aggressive as we are in terms of our
Right.
expectations for the bank. So if the market has to come to us, so to speak, then that probably would work in terms of in terms of being negative for the Canadian dollar. Where I would push back on that whole idea, or at least balance it out a bit, is let's see how risk trades. Let's see how
Mm,
global risk sentiment trades here for
right.
the next little bit. I mean, obviously equities are doing quite well, kind of the barometer, right, of risk, and credit spreads have come in a lot. I just looked at USIG 5-year index this morning, and we're back below 50. I think at
Wow.
48 or 49. That's very, very tight. I mean, so it's very pro risk.
Mm-hmm.
And generally speaking, the Canadian dollar does well during periods of a risk on environment, for lack of a better term, when global risk sentiment is pretty is pretty bid. So you kind of have you have the rate spread story, not helpful for the Canadian dollar, but you also have the global risk story, which is constructive. So net, I do think the Canadian dollar depreciates, but is this a runaway massive depreciation in the Canadian dollar? I don't think it is at this point. But the key or the caveat there is global risk sentiment has to remain relatively bid.
Got it.
If it doesn't and it falls apart for whatever reason or reasons, then I think Canadian dollar could be in some trouble.
Makes a lot of sense, Dustin. I feel like I could ask you questions about this for the rest of the day, but let's call it there.
Okay.
Appreciate you taking the time, and look forward to our next conversation where I'm sure there will be plenty more to discuss.
That sounds great. Thanks very much for having me.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.